Hello, everybody, and welcome back to another episode of Stocks with Stiles. Today we're going to be talking about stock market options, but before we get into that, I have to give the quick disclaimer that I'm not a professional. Basically, I don't know what I'm doing, and any advice that I give you, just do your own research before you actually start investing. This video is mostly meant to help people get familiar with the basics and just share what I've learned in the past couple years of stock trading. So let's first go on and let's look at what are stock options. So a stock option is just a contract saying that you want 100 shares of this stock at a certain price, and it's used to speculate a stock movement, and you can usually get them for cheaper than actually just buying and selling the stock because you can use credit on it. So let's look at that. We'll come back to that screen later. A stock that I like to use often is this one right here, ticker symbol APHA, if it will load. There we go. So this is a cannabis stock, and you can see that they are pretty volatile. In the last year, they are up 44%, which is pretty good. But let's look at options trading. So when you first pull up an option, you get all of this information that you probably don't know what to do with. And hopefully I'm going to be able to walk you through all of that. So the first thing is you've got your buy, your sell, your call, and your put. And I'll explain all of those in a moment. But over here you have the expiration date. Now I typically like to trade options that expire at the end of the week. So this one expires December 31st, or you can go out January 8th, 15th, 22nd, 29th. Most options expire monthly. I just personally find that weekly options, you get a better turnaround and you gain more money to invest. The further you go out, usually premiums become higher. So right here, that's a 71-cent premium versus if we do it at the end of this week, that's only a 12-cent premium for a $75 strike price. Now, what this is that I'm talking about, this is a premium that is basically whoever is buying the contract will pay this much on top of the share price to get it at the strike price. So what this is you have your strike price, which is how much you would be buying the share for. You have your share price right here, which is the current price of the stock. You have your break even, which is what the stock needs to be at for you to get money. And you have the percent change to break even and the monetary change that you would need. So let's take a moment and let's go back to our PowerPoint and let's look at what all this means. So let's first look at a call option, and let's say that you decide you've got a little bit of money, you've got a stimulus check coming in, and you want to invest all of that money into a stock like GameStop. You're a young guy who likes playing video games and you just love GameStop. Well, so you're going to call up your friend Gary, and Gary over here already has 100 shares of GameStop. But Gary just took a bunch of games over and traded them in and only got like $5 store credit. So he's pretty upset at them. So he wants to get rid of those stocks. So you're going to tell Gary, hey, GameStop is currently trading at $20 right now, but I can't come and meet up with you to get those stocks. So I'll give you an extra $5 if you'll hold on to all of these stocks for me until Friday when I can come and get them. And Gary's going to be like, oh, you know what? Not only do I get to get rid of my stocks, I get an extra $5 premium on top of that. I am totally for that. So you meet up with Gary, you send him the money, Gary gives you the shares. In this scenario, you have the money, which for me, I consider the money as the premium, which if we go back here, when I say the money, you can consider it the strike price or what you're buying the stock for, but I like to think of it more as the premium for this example. So right here, remember this is times 100 shares, so that's $12 to buy 100 shares of the stock. So you paid Gary $12 to buy 100 shares of GameStop on top of the money that you needed for the shares. The stocks go to the buyer. The premium will always move in the direction of the seller. Let's look at a put option this time. So a put option is going to go in the opposite direction. The put option, you have 100 shares of a stock, or the buyer has 100 shares of a stock that they want to get rid of. So they're going to call up their seller. The seller of the contract has a bunch of money and wants to make this contract, so the stocks and the premium will go to the seller in this case. Now what this means is, let's say I want to buy, or I don't like to buy, I like to sell. Let's say I want to sell a put for Afira. So it is currently trading at $7.13. This $7.50 put looks pretty decent. I think that the share price might go up above that, and I'll get $50 for this, which means I'd basically be buying the stock at $7. So I'll click on this, and I'll say, yeah, I like that. And you click that you want that. You'll come to continue, one contract. And now the thing about this is, for Robinhood, unless you enable margin and credit accounts in your settings, which I wouldn't recommend doing, that's how people start to lose a lot of money, you actually have to have the money to buy 100 shares. So I have to have $750 to cover the 100 shares of this if this contract gets executed. Now there is a chance that come Friday, whoever bought my share or my contract can say, you know what, Afira went up to $8, I can sell it for $8 instead of $7.50, and I don't want to execute this contract. So they cancel the contract. I get to keep the $50, but I don't get the shares of Afira. So in that scenario, the buyer always has the power to make more, or to cancel an options trade. So let's look at something I made earlier today, actually, is this little piece here. I'm going to do this so that we can actually get it all in the frame. This is just a little Excel sheet that I made literally just this morning, and it's for keeping track of your call and your put options, because this can start to get really confusing with the way the money flow works. I'm going to pull up my Robinhood account really quickly and show you something. Now, when you look at my 3 months here, you'll see that in the past 3 months, I'm up 12%, which is pretty good. Most of what I'm doing is trading options, and I didn't start out with $3,000. I started out with about $500 and have grown that up over time by adding money in from my personal funds. But you see these big dips right here, especially right through this. And part of that is that, yes, the stock market does just fluctuate. It does go up and down a lot. But something that I find interesting is that this graph shows how much you make or lose in a stock. So if we go back here to our options, and we pull up the options, we'll notice that if you want to sell a put option, the premiums get higher with the strike price. Now obviously I don't really want to say, oh well, this is trading at $7.13, so I'll come up here and I'll buy it for $11. You know, that doesn't sound like a great idea at first. But when you come up here, you'll notice something strange. This $13 strike price has enough of a premium that you basically would be buying the stocks for $6.87, which is much lower than what it's trading for. Now the chances of these getting executed or getting bought are not always very high. So if we look at this one, we can see that the volume here is 0. Nobody is trying to get that, versus down here volume is 28. That's typical considering the stocks aren't actually open today. That means 28 people have a hold on this trying to either buy or sell this specific contract. But like I said, let's go back up here where we have this really weird one. We can see that it doesn't have any volume, but if it did have volume, if somebody did buy it, then while you would be receiving enough premium to buy the stock at $6.82, on paper it looks like you paid $9 for this stock, which means you immediately after buying this stock, your graph is going to show that you lost $3 on it. And when you buy 100, it's going to say that you're down $30. So that's something I find really interesting about this, and that's the reason I made this. So I have my little template. This was a test sheet, so ignore how crazy these numbers are because they were designed to test and make sure everything works right. So for this scenario, this was just again making sure that I have all of my formulas correct. But in this scenario, I have ticker symbol test, and I say that I sold a put option for it because I only sell options. I personally don't like to buy options because it's a little bit more risky and you tend to lose money. The reason people buy options is you can buy them on credit and you get the chance, you have the power to execute them. So if you look here at Etheria, if you say that you want to buy a put, then remember in a put option, the buyer has the shares. So if we go up to our PowerPoint here, remember that the stocks go this way and the premium goes this way. Now remember, we moved these boxes earlier, and I don't know if I can undo that. Yes, so we have the buyer right here has the shares, the seller right here has the money for a put option. So if you've got a bunch of shares of this stock and you think they're about to go down, so you say, you know what, I want to sell this off at $7.50. I'll pay somebody $50 to buy 100 of these. I'll basically be selling it at $7, but then the stock falls down to something crazy, like it falls down to $4. Then you just mitigated that loss. Instead of losing all of your money there and having to sell the stock off at $4, you sell it off up here technically at 7, so you get to keep a lot more of your money that way. And then a call option is similar. If you think that the stocks are going to really shoot up, then you might buy a call option at a low or a high price and think that, yeah, I'm going to buy this stock for $7.62 and it goes all the way up here to $10 and I make a huge profit. That's the reason people would buy. I typically sell because I like to have that premium. And most of the time when I sell, it's stocks that I want to hold on to anyway. But that's what this PowerPoint is for, is if there's a ticker symbol test here, and we'll say the share price is about $5 because that's easy to think about, and I somehow get this insane strike price of $50 with a $4 premium, because remember that's times 100 shares, and it's that my break-even price winds up being $5, which would be right on what the share is trading for in this hypothetical scenario. What I've done here is I've developed a way to calculate how much I gain and lose in only stock prices, ignoring premiums, and how much I gain and lose including both stock prices and premiums. And the reason for that is come the end of the year, when you start to pay taxes on these stocks, you pay taxes on the difference between how much you bought the stock for and how much you sold the stock for. So that's one of the main reasons I like to do buying or selling calls and puts, is because I can buy stocks for a higher price and sell them for a lower price in a way that I still make money, but it looks like I lose a lot because you can count that off of your income taxes up to a certain amount. So this year I won't be doing any of that because I didn't make enough money on stocks to even report it to the IRS. But as you can see, I've got some sheets down here, and my plan is to have a different sheet for every ticker symbol, and I plan on keeping a really tight watch on everything that I trade for the year 2021. I want to talk a little bit about specifically selling because that's what I like to do and that's how I make most of my money. When we go into specifically selling options, you have the premium goes to you and you get to, usually I sell options on stocks that I want to keep anyway. So let's look at something, Ethereum and Nokia. I don't necessarily want to hold on to them long term, but they're a good cheap weekly option stock and I do what's called the wheel method. Now the wheel method is I I sell options for puts, and if the option gets executed, I turn around and start selling call options on the same stock. That's why I have 100 shares of Ethereum, 100 shares of Nokia. For the wheel method, I actually have a list of weekly trades over here, and all of these are just things that I would trade and then try to get rid of after their option. But what I would do is you'll see that some of them, specifically these two, Ethereum and Nokia, I have 100 shares on. That's because I just haven't had anybody executing a call option on them recently. But let's look at something like AT&T, which is just a really great company for this. I obviously don't have enough buying power to do trades in this yet, but I'm hoping to grow to that. So looking at this method, let's say that you buy this $29 AT&T put. You get your break-even price is pretty much the same as what the share is going for right now. So for selling a put, I tend to ignore the actual premium because the premium goes into buying the shares if it gets executed. If it doesn't get executed, then you get to keep the premium. Congratulations, you've made $43. If it does, however, you have to come back here and you have to look at how you've actually already used that premium to buy this share at a lower price. But now you have 100 shares of AT&T, so you can switch to doing a covered call. So a covered call means you have 100 shares of this company and you're offering to sell them at a certain price. So remember, you bought it at $28.57. You click right over here. You can click on basically this same call. Usually you'll want to go down one because for a put, above the share prices in the money, and for a call below the share prices in the money, that's where people want to buy puts higher and they want to buy calls lower because the buyers are going to want to sell for more and the buyers are going to want to buy their stocks for a higher price. But even if you do decide you want to use this $28.50 call option, when you bought it at $28.57, you get $39 for this. So it's basically the same as selling this option or selling your stocks at $28.89. And the thing I like about selling calls is when you buy a put, your premium gets put away in with the money that's being used to potentially buy these shares, so you don't get to just have instant access to that. When you sell a call, all you need for collateral are the 100 shares, which means you immediately get this $39 that you can put into reinvesting for that week. So that's why I like to mostly sell, and that's called the wheel method because you're just cycling through stocks. You buy a put. If the put doesn't get executed, hooray, you buy it again next week. If the put does get executed, you switch to selling a call on the stock. If it doesn't get executed, hooray, you've made money and you get to do the same thing next week. If it does, you just go back to selling puts, and it just creates a big wheel. I do actually have something else I want to talk about at the end of this video because two things that I did on my first video that were wrong. One of them was I didn't really bash Webull, but I did say that it didn't have options and it wasn't a app I like to use. Well, I have since learned that Webull does actually support options. The original article I read about it said that it didn't, but when I got the app, it does support options, and I love Webull. Like, this is my Robinhood home screen. It's pretty simple. It's got a little bit of news. It's got my shares, how much they're worth. It's got my ups and my downs. This is my Webull home screen. And this is a lot. This is just what one stock looks like. This isn't even really my home screen. And the thing that's great about Webull is you actually have volume analysis on a tick-by-tick basis. So right now, this is all pretty stagnant because the markets are closed. But come tomorrow, when the markets are open, this is going to be moving constantly, and you can see how many people are buying, how many people are selling. You can see down here how many people are buying and selling, but that number will just be constantly fluctuating back and forth. Okay, so looking over the desktop site, it seems like you can't buy options on the desktop, or you probably can and I'm just missing it, but I definitely can on my phone app. I have definitely done it, and I wish I could record and show you how to do it because there is just so much extra information on Webull, and it is extremely worth it to me to just have that as a tool. Going back, last video, I also said that there were some people that I would recommend looking up, and I totally forgot to put their channels linked in the description of my video, so I went ahead and just put them at the end of this video for you, and hopefully you enjoyed. Hopefully you'll enjoy seeing some of the screw-ups that I made here that don't get edited out. If you did enjoy, please go ahead and leave a like. Consider subscribing. I will say that the next video that goes up on this channel will likely not be a stock video because I want to branch out and diversify my content, but I will regularly be updating my stock videos and posting more. As I learn more, I also want to share that knowledge and help my viewers. So consider subscribing, consider liking, comment if you have any questions, or if I said anything wrong that you feel the need to correct, please let me know down in the comments. Thank you for watching, and have a great day.